what's happening here? And so I want to start there, and maybe Steve, we could start with you and bounce over to Edgar. You've recently had an investment committee meeting. How are you viewing hedge funds in general, present day, and kind of how are things looking forward for you guys at the J. Paul Getty Trust when hedge funds come up in the room as compared to all the other potential investment options that you have?
All right, I think can you hear me? Okay. It just comes back to kind of redefining what the role of hedge funds is. And typical endowments or foundations were heavily equity oriented, whether it be private equity, public equity, or even credit that has a beta to equity. So I've already said the role of hedge funds is to be a diversifier. We're looking for limited correlation with equity. So if there is an equity sell-off, we've got a little bit defensive mechanism in the hedge fund portfolio. So there isn't a lot of equity beta in there. It's also a secondary source of liquidity. In the event, again, the public equity markets sell off, we still have to raise money to pay the bills every month. And we also have to raise money to rebalance if necessary. And we're a foundation, so we're a little different. We don't have any new money coming in. We only have money going out the door every year, 4 to 5%. We don't have a fundraising machine like USC. If they have a sell-off, they just tap the alums. Hopefully not the recent alums. Like Edgar knows my son who just graduated from there. Sorry.
We're gonna call Steve tomorrow.
Yeah. But so we really have to plan for liquidity. So we need this diversifying stream, and that's again, performance has lagged an incredible bull market. Public equities have been 13% for the last 10 years. If you think that's going to happen again, great. Put all your money in public equities. If you don't, you need something else.
So it's not for this outsized alpha generation. It's, as you said, a diversifier, and to kind of even things out in, should the rough patch be around the corner.
Yeah, unfortunately, I think those outsized returns disappeared maybe 10 years ago. So
okay.
That was the previous 10 years.
I mean, similar at the endowment?
No, it's similar to what Steve said. I think the one issue is you kind of paint hedge funds with a broad brush, and they are very different. And the way we think about them is similar to Steve, is being diversifiers. We also have hedge funds in our equity book and our fixed income and credit book, but those are very different animals, and our expectations are very different. But when we think of the main hedge fund book, it is as a diversifier. It is as a mitigator of risk. Now, we still want to make real returns, and you still need some expectation of real returns, but if you expect to keep up with equity markets for the last decade doing hedge funds, it's just not going to happen. And I think it's just making sure everybody's expectations are aligned so that hey, like if we're up another 10+% a year for the next decade in equities, like hedge funds are probably not going to keep up. If things are different, like they may actually do better. So it is the expectation, and again, if you're going to think to the old days where hedge funds used to make 20% a year, like that's definitely not going to come back. There's too much capital. There's again, I think one of the topics is are hedge funds dead? There's still $3 trillion in hedge funds, so they're not dead. So that means it's very competitive, and the expectations of returns have to be brought down to a kind of a normal level. If you're waiting for the 20% a year returns that you used to get, that's not happening.
Right. Well, and Jane, maybe Edgar brought up the 3 trillion kind of stat on where the hedge funds AUM has really been for a good amount of time. I think it might have maxed at 3.4 and back to 3 after what happened in December in the early part of the year. At your former firm, you guys did a lot of research and dug into a lot of data, and in prep for this, I took a quick look. Last 20 years, mutual funds have almost quadrupled in AUM. They're roughly 19 trillion now. The hedge funds are at this like 3 trillion mark, which is still a huge number. ETFs, which really weren't talked about, there might have been a handful back 20, 25 years ago. They've got 1,700 funds managing now 3.7 trillion. They've actually surpassed hedge funds. Can you talk a little bit about the numbers and the macro data associated with the space, and then how it's kind of formed your thoughts for starting out on a new venture here with Martlet?
Okay, so a couple of things. having worked in hedge funds, run basically a fund of funds for over 30 years, let me give you just some sense of going back. So when I started looking at hedge funds and institutional portfolios, it was something called the 80s. And I don't want to know who here wasn't born, please. Make me feel old. But there are a couple of interesting things about then. It was a very small, I put together one of the first databases of hedge funds, and I found about 400 over the course of a year. So that was it, 400. There's thousands, 10, 11,000 now to give you a sense. A couple of interesting things. Most institutional investors in the late 80s, and Steve knows this a bit because he also served a little bit as an investment management consultant, you went and talked to your clients about why BAA bonds were okay in your fixed income portfolio, and that wasn't considered bad. You talked to your clients about why small cap was good. And for those who were really, really, really adventuresome, we could talk about international equities, but of course everybody ran against IFA and you had to figure out what to do with Japan. So, that's what the world looked like. And interesting on the hedge fund front, probably about 60 or 70% of the hedge funds then had a hurdle rate in. So the fees were probably around 1 and, 15 to 20% with a good hurdle rate, 6 or 7%, because they could make 12, 13, 14%. Now you move to today. Today I can go down. There are several mutual fund companies that will offer me a leveraged loan mutual fund at 50 basis points. Leveraged loans have become very institutionalized. You talk about convertibles. People have, those people move cross-capital structure. I mean, you have long-only managers who, it's not the old balanced account where I'm going to put some in fixed income and some in equities and they don't mix. I mean, people move across the capital structure. So the exotic security types are very well known. So that's kind of disappeared from the hedge fund manager edge. Also, alpha, when you are 400 hedge funds, and I'm going to guess it was probably close to 10 billion, and yes, I've made many mistakes. I met Jim Simon on his initial funding raise and turned him down at Renaissance. So, that was 1992. I remember all this. But the thing is that you had an opportunity to make a lot of alpha. Hedge funds are alpha on steroids. And alpha's gotten harder for long-only managers, and it's also gotten harder for hedge funds because there's only you want to think about a finite amount out there. So the one interesting thing, so while what you call the scenario for hedge funds has declined, the one interesting thing is the fees have gone up. So I think that's just a very interesting.
Yeah, and I was talking to someone this morning right before the start of the day. Publicly traded companies in the U.S. have gone over the last 20 years from 7,600, which was roughly a top, down to 3,600. And meanwhile, you just mentioned 10,000 hedge funds, 9,000 mutual funds, 1,700 ETFs. We're talking about 20,000 fund products focused, this is U.S. only, focused on 3,600 companies. Right? And so the math, the macro math isn't working.
It's
right?
gotten a lot harder. And so I think one of the things, this is and I have done a lot of jobs in my life. Started at a big asset manager and then, built a big asset manager. But I've never had the guts to do the job that each of the gentlemen to my right and left have done. And when you're dealing with investment committees, they want to see historical data. But the problem is that's not how you make investment decisions. We all know that we were looking at the expectation on a go-forward basis, and it's a very hard conversation to have with people because it's very hard for people. People take a lot of comfort in the data.
Right. Well, and let's go back to Steve. Steve, you mentioned hedge funds as a diversifier for your overall portfolio. Dating back to my days as a partner with KPMG and Rothstein Cass through here at Agile, so we're talking probably 5 to 7 years, what we've seen in practice is diversification doesn't get discussed at the hedge funds portfolio level anymore. It's, 9 out of 10 launches that we see are highly concentrated portfolios. And so when I hear there are diversifier, are you guys with longer tenured managers? Are you seeing that in the books of the underlying portfolios, as I have across our practice, in that it's 10 to 15 names on the long side. It's 5 to 10 names on the short side, and so the diversification has moved out of the traditional hedge fund portfolio itself, and maybe now it's sitting up at kind of a macro level for you guys.
I'm not sure a lot in the older days that there were a lot of diversified hedge funds, and they were much more, they had a broader mandate. Many of them, there was a macro manager, or there were a lot of convert arb managers, a lot of arbitrage managers, or this merger arb. And they may have run concentrated portfolios, there's probably a lot of beta embedded in it then, but you were willing to take the beta because you were also getting a lot of alpha with there. It was not a crowded space. Now you've got a plethora of funds out there, strategies. It's almost a shopping list of what you want. So again, it gets back to what am I trying to construct? I'm trying to construct a diversified portfolio. But if it's, simple math, say it's 20% of our portfolio, and we have 10 to 20 managers, an individual manager is only 1 to 2% of the total endowment. You could get some highly concentrated, volatile managers, and if they're just 1% of your fund, it's going to come out to a kind of a lower vol fund if they're diversifying strategies. If you're putting it all into concentrated long-short equity managers that are highly correlated, you've probably just built a potential time bomb.
Right.
So again, you have to think of the objective. You can take concentrated, high vol, expected return managers, high alpha managers, and assemble them into a
So
smart portfolio.
You could find them in your book, but it's not going to be an overwhelming number. And Edgar, you looked like you had some thoughts on this also.
And I think it makes sense. A lot of funds have moved to that direction. Like we've discussed already, alpha is a lot harder to find. So can you find 50 great ideas in your 50th idea? Can you really find alpha there? Probably not. So it makes sense that managers have become more concentrated, try to focus on their best ideas, focus on what they do best. Now, that could result in either beta or more volatility, but then it depends on how you want to construct your book. And there are funds that we have in our portfolio that are more beta correlated, and that's fine. Like, we still think they have an edge in what they do, and there's alpha. We just put them in the proper risk bucket, which is our equity exposure, and that fits fine. And then there's others that are more diversified, less correlated, and that fits on our absolute return allocation, and that's a very different risk profile. So I think, it depends on how you want to cut up your risk and how you want to allocate. The concentration makes a lot more sense today. Again, the alpha is a lot harder to find. If you have 200 ideas, I'm really debating whether those are really 200 great ideas.
Right. Yes, Jane?
Can I ask these guys a question?
Yeah, of course.
Sorry.
Of course. Permission
So-
to treat them as hostile witnesses if you need to, Jane.
Thank you.
Go right ahead.
Edgar doesn't work for you any longer, so he can decline to
I
answer.
could say no.
So let's just say I was running a very big, third largest in the globe fund of funds at the time when I was running it. And let's just say that the world is changing, so you need to revise how you evaluate managers. But then there's the reality that every time you invest in a manager, there's the career risk. Why did I invest in them? And particularly, as many of you probably in the room know, PAMCO has always historically focused on new and emerging managers because big managers are well researched. And yet it's very hard, if you're talking about concentration, it's very, very hard to go in and say, oh my goodness, they're putting more than 5% in a name. Well, if you're only going to limit yourself to 5% in a name, that's a minimum of 20 stocks, and then you're on your way to 30 stocks before you know it, and then you get to your 50. Yeah. So have both of you guys changed the way you evaluate hedge funds, given the marketplace, and if not, why? And if so, could you tell how you're evaluating hedge funds differently than 5 years ago? I think that would be a great question.
Yeah, definitely. So I'm being, again, it's the classic, you have 20 names, you're on your way to 30. I had 15 funds, I had 20 funds, and I was on the way to 30. Time to put the brakes on. So now I'm having to concentrate the portfolio. So I've now got kind of a rule of thumb is to bring in one new manager, I've got to take 2 out. So I'm forcing myself to concentrate the portfolio. And I'm also looking across the managers. I have less overlap now with more funds than I did, 5 years ago with fewer funds. Because I'm finding somebody, okay, maybe they're in a different market. I have now have more money in Asia than I did before. I used to when I started, I've been at the Getty 12 years, and it was very much a U.S.-centric portfolio. Now I have dedicated European managers, dedicated Asian managers, so I've expanded the markets geographically. I've got equities, instruments, credit instruments, derivatives. So again, I've expanded the universe. There's much less overlap. And that's really when I'm looking at bringing in a new manager, I do not want much overlap in strategy, style, or markets, or actually if I look at underlying names.
Does that bring you to bigger managers?
No, it actually finds me, I've now got smaller managers, newer managers. So the average AUM of my managers has shrunk significantly over the last 5 years.
And your investment with them has increased on average because of that concentration, but the managers themselves, the total AUM has shrunk.
shrunk.
Yeah. Edgar?
I'm just going to take a different track. In terms of due diligence, it's changed a lot. It's changed a lot over the last 5, 10 years. It used to be you meet really smart people, you give them money, they can kind of figure it out, and you're like, okay, they actually tend to do well. Like, just being smart and having capital is just not enough. Like, it's finding that true edge, and which is difficult to really like define. It's like, okay, like what do you do better than everybody else in the world, which makes it much more difficult to really get in the weeds, get into the details of, okay, you're a tech long short fund. Why are you better than the other 50 tech long short funds? Like, what is your distinct edge in your 10th name? Why do you have it in the book? Why do you know more than everybody else in the universe? And that goes with like arbitrage and like, so again, you used to make very good money just doing plain vanilla convert arb, merger arb. Like, it's not enough. Like, you need something else there in order to either like you can allocate capital faster, you have, you know, a global mandate, you have something differentiated where the market hasn't already arbitraged it away to no alpha. And it's about finding that alpha and why that's consistent over time. It might, like the recent past may not tell you that. And that is the tricky part.
So, but I want to push back on that, Edgar, because, you know, I'm no longer
I
your
know,
boss.
I know.
But anyway, but
You can tell
but
we've all known each other for a long time, right?
how many hedge funds have you seen over your life?
Probably over 1,000 for sure.
I would agree with that, yeah. So how's a poor manager supposed to know what their edge is versus the competition? It's not like they can go around and see all the competition. I mean, I've never quite understood that when the client or the prospect is asking the manager what the edge is, because the manager has very little visibility. You've got a much better perspective.
Yeah, it's our job. It's our job. But I actually know almost.
Well,
I rarely ask the edge question. I think it's up to me to have a discussion on process and like talk about it, and for us as investors to figure that out. Because a lot of times managers don't know like why they're special.
Right.
And again, they don't talk to hundreds of other managers.
Certainly, and within our business, getting involved with emerging managers on a daily basis, pretty much helping them just articulate that, and just as importantly, why it's replicable.
So Vince, you work with all these new managers. Okay, we've got the kind of the consumers.
Yeah,
Here,
yeah,
who's
yeah.
given their version.
Yeah.
Now, you know, they like to think that they work out every day, but the reality is their gym shoes hang on the back of their chair. So tell me, Vince, where do you see the money actually getting raised? You know, I mean, when you look at the managers you work with, and obviously you probably have your own view of who's good and who isn't.
Sure. We're doing the same assessment before getting involved at Agile. We're doing the same assessment. We're not putting millions and tens of millions and hundreds of millions of dollars to work, but we're putting our time and investing our resources. And so what we've seen is obviously individuals coming off of large institutional desks or products, because they know that the process and the system is extremely important.
So what you're saying is that if you come from a very large, well-recognized manager or desk, be sure to highlight that.
And you respect the process, right? And being able to articulate that, obviously replicate that, and that's extremely important. And then the other thing that has happened over the last 3 to 5 years that I'm actually surprised, and I get a lot of pushback when I direct a dialogue in a certain way, is that I can't believe how many managers will not focus either their time or someone else's time that they bring in purely on capital raising activities.
People underestimate the length of time.
The time, the length, the hand-holding, and I say, okay, I don't know if we have anyone from BlackRock here. Anyone from BlackRock? I saw a name on the thing. They're in the real estate section. Good. Okay. So BlackRock has hundreds of people calling for capital, right? How many do you have, right? And you dry up the friends and family and prior relationship capital really quickly. And so one of the other big time trends we've seen over the last 3 to 5 years is most emerging managers launch with strategic capital. And that strategic capital is going to do a couple things for them. It's going to give them quick scale, and it's going to give them some staying power so they could actually prove out their investment process.
And what size would you call, what's the minimum size for strategic capital in what you think to be viable?
50 to 100 will get you break even with your infrastructure costs and kind of setup. And depending upon how complicated the strategy, you're going to be higher or lower. And so the other interesting thing we've seen on the other side, because we're taking all these meetings with the institutions and listening to them, is how many institutional investors are looking to essentially, and your prior shop did this extremely well, looking to through an arrangement via strategic capital, juice the alpha. But it's really not juicing the alpha, it's taking down the fees so that, or sharing in the revenue so that you get those 1980, 1990 returns because you're actually sharing in the revenue stream, you've reduced fees so that the compounding over multi-year periods. So, that was going to be another question. We're seeing that. I'm not sure if you guys have gotten into that type of dialogue on rev share or fee reduction where PAMCO is solely let's get the best fees we can and have that compound over time. Steve or Edgar?
No, I think everybody wants the best fees they can, and I think you have to have that discussion up front. There's some where there is no debate and you kind of take it or leave it, and others where there is sort of that give and take. I think where fees have gone wrong is sort of that alpha share component has just kind of gotten skewed, where all the alpha has gone to fees, and then the investors are left with like, well, the GPs did great, but the LPs are like, this is not great. And that's where people complain about hedge funds. It's like, well, they're generating 8% gross, but after fees, it's like, it's 4 or 5, and you're like, well, is it really worth it? Like, you could almost just do fixed income. Like, why am I spending? Why do all this brain damage to do that? And I think that's where there has been a bigger debate today, which I think is we should be having about fees, fairness, kind of the give and take of like, what are we actually paying for? Should we have benchmarks, hurdles? Like, so for the equity side, it makes a lot of sense to have a market hurdle, right? Like if you're going to be 80% beta long, like there should be a market hurdle there. Like you shouldn't get paid 20% for having beta, and like paying a lot for beta is sacrilege. Like you shouldn't do it. Like you can get it for free, and that's we've had a lot of debates with funds on that. That's been a big debate.
Yeah, and this is where I think some of the biggest changes happened over the last 5 years in particular is alignment of fees for the strategy and for the investors. Years ago, people used to get 20%, cash would return 5%, and the manager would take 20% of that. They'd get 1% for doing nothing. So again, you're starting to think, hey, if we want to put a T-bill hurdle in there if bills ever go above 2% in the future, or we want to have some market measure or just an absolute number in there so that there's a better sharing of the returns. Again, the simple math with the old 2 and 20, if a manager to do 12% gross, the investor would get 8% net. Well, the manager just took a third of the gains without putting up any of the capital. I think almost anybody would take that kind of opportunity. That's a great option for the manager. So now we're trying to, let's make it a little more reasonable. You know what? At 1 and 1.5 and 15 or something, you can still make a very good living. You may not be able to buy a sports team, but you can make a good living. We can do, better returns. It's a lower return environment. So you really have to rationalize what this is and for the risk profile of their strategy.
You have to downsize the jet.
Yeah.
I was going to say, soccer is still cheap. You could get a franchise pretty cheap.
But another thing, getting back to what Edgar's seen 1,000 managers, it's probably up there too. But if we're going to see 100 different strategies or funds in a year, and we're going to hire 2, it's pretty easy to discard somebody. So we're not going to spend a lot of time says, yeah, that's interesting, it's solid, but I've already got something like that. So all the time people, we've done 8-9% annualized over our lifetime. okay, that's really not going to displace anybody in the book, or that's not going to fit a role that I don't already have in my book. So again, without any new money coming in, it's a really high hurdle rate to get a new manager in our portfolio. So people say, oh, we've done this really well. I go, yeah, but I've already got that. So I need somebody who's really, I can slot in there for an exceptional risk-return role within the portfolio where I feel like they do have some advantage. And they may not know what that is, but because I've seen these 1,000 managers, and I know my portfolio. They don't know my portfolio, but I can say, this fits. I'm going to spend more time talking to this manager about this strategy.
I want to take a moment and see if anyone in the audience has a question. I want to wait till the end and run out of time. Sure.
Following up on what you just said, how do you measure performance when you've got different managers on different pages, different strategies, processes?
It's what I expect out of them. And it's not just what they've done historically because, again, we're going to, history does not necessarily repeat itself and there will be a different market environment. If they're focused on strategy, might be a more volatility-oriented strategy, I said, okay, my expectations are now higher for them because I think we're going to be in a little higher return environment going forward. So their expectations have gone up. A long-short market equity manager or a market-neutral equity manager, I say, again, we're seeing more dispersion now. I would expect the returns to be a little higher going forward. They're not going to have the same returns. I'm not necessarily judging them against these others. Expectations, why did I hire them? What did I think they can do? And will they continue to do this in the current or expected near-term market conditions?
Yeah, I think a big issue people have is just putting all hedge funds in a lump and saying, okay, like this fund's up 5, this fund's up 10, one's flat, like the flat sucks and the 10% is great. It's like, no, like each one's different. Like if the 10% one was invested in all tech, tech long short, like over the last few years, it should be doing 10 or it should be doing 15. And the 0 one, maybe if you were in a distressed fund and just haven't had opportunities, and like that still could be fine. So I think it's judging each on their own curve makes the most sense.
How can I ask another question? Sorry.
Of
I'm sort of taking your
course.
job.
It makes my job easier. Go right ahead.
He's a panelist. So how annoying for Edgar and Steve is it? I know it was super annoying when we were at PAMCO. Like we could that's why we had position level transparency. When you're building this diverse portfolio, so people are filling kind of different slots, and then people feel performance pressure and they start migrating to what's performing better. How often do you want to strangle those people?
Well, I see in the audience a former fellow co-investor in one fund who did exactly that, and we got most of our money out before they really screwed up in the fourth quarter. And it was somebody who tried to do something they didn't do. And yeah, I hope they're out of business in another year, honestly.
No, that's an issue. Again, there's not much we can do. We can't run their portfolios. It's you maintain that due diligence. You know what they have, and if you make a decision later on that you have to redeem, you redeem. Like if people are correlating and just like, oh, like software is great. Let's invest in software. Like, yeah, that's like if you're a value manager and you do that, that's probably not a good idea.
I think it was J.P. Morgan just came out with their most recent survey this past month, and style drift was still front and center amongst the institutional investors. I think it came out second. Crowding was the number one concern by institutional investors, and style drift is still up there on the list.
Okay, so, and then my question for you, Vince, is, before you had Agile, you were at KPMG and Rothstein Cass and stuff. So I'd like you to include all of that experience. So it's not just your Agile clients now. How often have you had hedge funds call you and say, now, how does the security work? How do I book it? They've kind of gone off the reservation.
No. I'd say not as many as you might think, but clearly where we saw it, it wasn't between industries, it was public-private, and obviously a huge red flag where we saw managers starting to delve into the private markets, and maybe the PPM, which thanks to all the attorneys in the room, give them godlike qualities to make a decision to invest wherever they see fit, and so they would drift in the worst way from my standpoint as a former audit partner, and now we haven't seen it as a CFO, where you're going completely out of scope for what your bread and butter is, and there's so many conflicts associated with it, and you've got an open vehicle from a liquidity standpoint. Now you've tied up in a private investment, and
I'm going to bottom line this. If your hedge fund manager starts doing privates,
Done.
double look.
Done. Yeah. Done. No, and
Especially if they've never done privates, they have no expertise.
And so again, I think it's almost a last ditch effort by the manager, and it's painful to say it sometimes, but it really is. And so, any investor worth their weight is going to be looking at that in some manner, shape, or form on a very regular basis. Yeah, did I answer your question?
Yeah,
I don't want to get
I'm
beaten
sorry
later.
I'm
So
sorry.
the beatings will continue until you answer me. All right, so let's go back though, because I think you didn't fully answer my first question, Jane. Talk a little bit about the pivot, from PAMCO to Martlet, because I think it's a pretty significant pivot, and how you're viewing the next 5 years, 10 years, and why now was the right time to do that pivot.
Yeah, so I'll just give you the 2-minute blurb, and I apologize if it sounds like a sales spiel, because it's not. I mean, anybody can, I'm talking more about strategies. But, at PAMCO, doing emerging managers, we had a separate fund platform, very large one, still do. They still have it there. And, hire new managers. We just don't want to take mark risk, where the assets go risk. We can negotiate better lines, better terms, economies of scale, yada, yada, yada. But looking at that, since we were in the middle, I felt very strongly that we had to exercise appropriate fiduciary oversight of that. And so we had a fully baked out risk thing. So our back office looked like a big multi-strategy. Pick your favorite $20 billion multi-strategy. That's what our back office looked like. And our front office looked like a fund of funds. And so what we noticed over a long time period is, in the mathematics of multi-manager investing, is you can find people that do narrow things, and you can build a lot of narrowness, but there's this temptation to kind of congregate around things. And so a manager can think they're being very concentrated, but we're running portfolios of very well diversified portfolios. 60 to 80% of it can be explained by small versus large, domestic versus foreign, stocks versus bonds, credit versus this. But we're still paying active management fees on it all. And so we launched this fund in February of last year. It was one of the things I'd been working on for several years at PAMCO. And then, to kind of say, look, let's have a fund that's very low fee. So it's 75 basis points with no carry. And the reason being that it should be priced kind of like an R2 manager. That this is not, we're in the hedge fund space, but there's not really any alpha here. These are the big factor exposures. Alpha is very hard to get, and individual security election is pretty important, but that's what I think there should be a split. People should think about it in the two ways. And for a whole host of reasons, primarily, one of the huge reasons is that I felt uncomfortable, even though regulatorily wise and all those otherwise, we were very comfortable the way we'd set it up. It just didn't feel good having a lot of emerging managers there and all this data floating around, and having this also entity that's kind of doing this sort of factor-based stuff. So we spun out at the end of the year with the fund. We took the fund, all the IP, life moves forward. And I think investors really need to rethink. I think investors need to think about risk budgets across their whole plan, but I also think they need to think about fee budgets across their whole plan at varying different levels. Fee is the only thing that's certain. I used to say a positive return from treasury bills is certain, but look at what's happening around the globe. And so people need to think about where they spend that money. And I'm not arguing that the fee budget should be low, but I think the wrong way, and there's been this big mode out there to sort of say, this is the fee, take it or leave it. There's been some high-profile efforts to do that. I think that's really wrong, because you end up overpaying a bunch of people who shouldn't be overpaid, and you end up having a lot of really good people walk away, and so you end up with a very bad situation. So what I'm arguing is that, in the hedge fund portfolio, but it also extends to the overall book, there should be a very big cognition of a fee budget, where do you spend your money, and actually arguing that good hedge funds should be paid more. And
For real, true alpha.
for real true alpha. And people who are prime factor exposure should be priced more like their R2 for me. I mean, that's my view, very strong view. And that's what I'm going out there and doing. And, you know, obviously my firm has a solution on the cheap end of it, but I feel very strongly at that point, regardless if they use us. I mean,
Yeah,
there's
no.
some other people out there.
No, it's a lot of times when we come into a larger manager that's gone into kind of that mid-sized tier, we're cleaning up a lot of expenses that were unnecessary, even at, you know, when they were larger, because it's just like the big house syndrome. You're going to fill up the rooms with something. So
Yeah.
how did it, I was going to ask Steve, how it made you feel when you heard, okay, we've got, you know, kind of this blend of hedge fund, ETF, you know, all in one, you know, just I know you guys know each other from prior
Yeah.
shop, but
Just so, I mean, and you can't think of, this is a hedge fund discussion, there's no generic hedge fund. There's an allocation, and overall, okay, great, I'm putting together a hedge fund portfolio, but it also has to fit together in the total endowment. So it's, okay, each manager has their specific role. How do I evaluate them? I evaluate each of them differently. Each of them has a purpose. In the end, I have to think of them as rolling up into just a subset of what the total portfolio is. So I'm not trying to build a hedge fund portfolio and say, damn the rest of the portfolio, because that's 85% of the, you know, what pays for the Getty Museum. So really, my hedge funds, okay, that's a little roll, and there's no generic hedge fund, and whether it be fees, expected returns, correlation strategies.
all right, let's do one more question because we're running on time here. Yep.
Curious what you guys think about the proliferation of hedge fund managers returning capital, family offices, really at this point in the cycle.
Okay. So the question is, hedge fund managers returning capital and essentially becoming family offices. Well, so we'll start and we'll go all the way down and I'll close it.
Yeah, no, I give them some credit for doing it. Obviously, it's easy enough. You know, Appaloosa, he could have kept going for years and years, collected fees. I think when we analyze managers, that's one risk we analyze is like, all right, how much has somebody made and what's their incentive to keep going? And I think looking at incentives of people, and again, it's a people business, we kind of always focus on the incentives. It's like, so how much capital do they have invested? How much money do they, what is their net worth? How many football teams do they own, or how many like baseball teams? Like all that factors into them as people and what their focus is going to be. And again, I give the funds credit for saying, hey, like I don't want to do this anymore. I think that's a better solution than saying I'm going to just keep doing it in kind of a half-assed way and not make as much money for my investors and just wait till it dies. So.
Succession is an extraordinarily hard thing to do. Knock on wood, my head maybe. We did a good job at it at PAMCO because hopefully this succession works. Very few hedge funds have succeeded that. I think it's way better for people to call it quits and give the money back. And I have a tremendous amount of respect for the people who do that rather than trying to. I've seen a lot of big hedge funds die over the years because the people don't want to give it up. They effectively stop working. The outside world doesn't understand that normally. And they bring in lieutenants and they start putting more and more on that and the returns degrade. And so I think that's great. And I think there's several big hedge funds out there who should turn into family offices that quite haven't yet realized it.
Yeah, that's more managers should return capital. You know, right now they're just gathering assets. It supports their business or lifestyle, and they're not interested in maximizing return, which gets back to why I've had a more recent focus on smaller managers that aren't rich, they're hungry, and I know what their motivation is.
And I echo all that, and I equated everything almost always to sports. It's like the John Elway retirement. You know, you win 2 Super Bowls and you go out on top, but there's a lot of players that hang around and don't look too good into their later years.
Well, I knew it was time to hang up my shoes when every single product at PAMCO was outperforming in the middle of last year. That never happened.
There you go. All right, well, listen, help me thank everyone here for participating. We'll hang around outside if you want to ask any more questions, and thank you guys so much.